Welcome back to another episode of the Building Equity Podcast for Real Estate Investors. I'm James Schlimmer. With me, as always, is Mr. John Bowens. John, how you doing, man?
I am awesome, James. Thank you so much. Really excited today. The man of the hour is Dennis. So I know I usually have some introductory comments when we do these podcasts together, James. But I think what I'll do is I will just save those maybe for the very end and let you jump right into the news and then get Dennis in here because I know he's got a lot of good information to share with the group today.
This will be awesome. So for the folks that seen us, it's the first episode that we're doing where two of us are virtual. So bear with us as we're switching around here. But you know, who knows what will happen. Dennis Cisterna, Chief Investment Officer of Lafayette Communities, a build-to-rent expert, is with us. Thank you so much for joining us.
Thanks for having me. I really appreciate it.
Now, no problem at all. So, John Bowens, I had the pleasure of sitting in the crowd at a Build-to-Rent conference in Scottsdale a couple months back, and Dennis was on a panel, and he does not hold back about his sentiments for the economy, for what he thinks about the build-for-rent space, real estate investing. I hope he could be a repeat guest for us here. So, again, thank you for taking the time. As we get started here, John Bowens, we got to do our segment. You know this.
News.
It's
what
news.
Do you got,
and
James?
Well, real estate news that you guys would care about. Let me look in the camera here so I can be a grown-up. Real estate news you should care about is brought to you by IRA Title Pro. If you're buying or selling real estate using your IRA on your next real estate investment transaction, try closing with IRA Title Pro. You're going to enjoy a full-service title company that focuses exclusively on IRA real estate closings, faster close times on average of 11 days, faster. Experienced closing team that also understands fractional interest in the IRA when the IRA owns a small percentage of the property, let's say. Awesome proactive communication, competitive closing fees. Visit iratitlepro.com. And with that, when we talk about the news, let me do a wide shot here so it's all of us. And Dennis, feel free to jump in. The biggest news right now as we record, it's February 24th. About 10 p.m. last night, Russia decided to invade Ukraine. And I know we talked about on early episodes, what would be the market response? You know, they talked about 10%, the stocks would go down and so forth. I think today we're a couple percent down overall. I mean, everything just took a hit. Crypto, major stocks. What are you seeing, Dennis?
I'm seeing the same thing I've seen for the last week, which is this steady decline in market values and a lot of trepidation. How much of that is related to Putin's actions in the Ukraine versus everyone's overall concern with rising interest rates? I'm not so sure. It certainly doesn't help things, I can tell you that much.
John, what are you thinking today, bud?
I have been having a lot of conversations, and a lot of the folks that are reaching out to me, real estate investors, that is they're looking at inflation, and they're looking at their stock portfolio, their traditional financial market portfolio, and they're trying to make some decisions, and some rather tough decisions for some individuals. But inflation, I would say right now, is probably taking precedent over anything in the conversations that I'm having. And so folks they're looking for asset classes that can be a hedge against inflation. As we talk a lot about real estate, particularly for investors here at Equity Trust, they're focusing on using their IRAs and 401ks and other retirement plans. So naturally, a lot of the folks that I'm speaking to on a daily basis are looking for ways to safeguard their hard-earned retirement dollars. And many of them are looking to migrate their current positions into a cash position to then move into a real estate type position, whether that's land, individual rent homes. For those that do fix and flip type transactions, are looking to invest in those types of asset classes.
John, it makes perfect sense. And what I love about the conversation you talked about with inflation is literally sitting in the crowd. Dennis, I'm not going to say it was your panel, but it was maybe on the last day of the Build for Rent conference. Someone said that the hedge against inflation is real estate investing, and is this build to rent, craze, I guess you'd say. So my question, Dennis, here, just to cue it up for you, is can you give a little bit of background about what you're doing as CIO at Lafayette Communities, and can you give kind of an elementary understanding, or what is build to rent and why is it so popular today?
Sure. Well, that term has evolved quite a bit in just the last couple of years, but essentially what it is creating purpose-built rental communities that have traditionally been in the for sale market. So instead of high-rise or mid-rise apartments, what you're seeing are fully detached homes, townhomes, even bungalow-style villas that are built for the sole intention of owning and operating them as rental properties. So this is part of the housing stock that traditionally went to the for sale market and is now being built for the purpose of long-term rentership. And so when that first started, it was really kind of taking the cast-offs from home builders, developments that maybe a public home builder wanted to hit their quarterly numbers and would decide to sell an entire community in bulk to an institutional investor. But given the scalability in this space, because you can go take an entire community of 100, 200, 300 homes, it's attracted a lot more institutional investors. And so now not only are folks buying, these inventory homes from home builders or doing a forward commitment on entire communities, they're not going in and doing the entitlement, the land development, the vertical construction themselves for the purpose of this long-term build-to-rent trend. And so it's not just the existing large home builders that are really playing and creating that inventory. It's a whole new set of market participants.
Now, would you say, Dennis, that we're the show Building Equity is we're reaching out to entry level real estate investors, possibly intermediate level. These are folks that may have maybe 1 to 5 homes that they're, I'll call them mom and pop investors.
Sure.
When you talk this build to rent space, at least in the news, when you read in the Wall Street Journal or Business Insider, all of Wall Street has their eyes on this market right now. It sure seems like it's a little bit more complicated, I guess you would say. And you would say, what would you say to the entry-level investor that says, how do I get in on this?
Yeah, well, really, what is garnering a lot of the press are substantial commitments of equity in the space from some of the largest private equity groups, endowments, pension funds. And that allocation of capital and what they're doing is not really relevant to your mom and pop investor. But that doesn't mean you can't participate in it. And I think at a high level for your viewers and listeners, what makes the most sense on why this is an appealing space, even for someone that is a relatively novice or smaller investor, is you can go into a market and look for a single infill lot. I'll use Jacksonville as an example. Jacksonville has thousands of one-off lots within a 15-mile radius of downtown that can be developed, where a lot of smaller home builders will go in and do a spec development and sell that house. Well, smaller investors have the same opportunity to go in, develop that house, and own it long-term for as a rental property. And so there's a couple nice key elements to consider as a landlord. Number one, being a small landlord is a pain in the butt. I think everybody knows that. Having to deal with tenants, having to deal with maintenance issues. And one of the benefits of having new construction is you're taking a lot of that maintenance headache out the window, right? You've got building systems that are under warranty. You've got brand new construction, so the chances of repair are much lower. And that also reduces the amount of money you have to put back into the property over the first 5 or 10 years as well. So there's some definite advantages there. In terms of first steps, you can obviously go look on Zillow or Realtor.com and just literally look under the land tab, and you can see, look for land where the average land size is under 10,000 square feet, and that will show individual residential lots. You can also talk to your municipality's housing authority, because the city actually owns a lot of lots in most places as well that are ripe for redevelopment, and usually they offer some type of nice incentives for developers that want to come in and try their hand at adding new housing to that local area.
Dennis, James, if I could jump in and ask a couple questions. So Dennis, again, thank you for joining us. To have somebody of your caliber on the show and be able to ask as many questions as we can for the short period of time we have together is just great for our viewers. So viewer questions that we know are coming in. Number one, let's say I'm a real passive investor, meaning that I'm not going to go out and buy land and figure out how to develop it, hire a builder. I'm looking for something that's really just turnkey, if you will. Where are those types of opportunities? If I'm an investor that is looking for something that is already built, we have the new construction, we're ready to go, it just needs to be tenanted and managed. Where do I get started with that?
Yeah, so there are, let's call them websites, kind of clearinghouse websites like roofstock.com, which will put inventory out there that's already built, and also can even have management come in tow if you're really looking to have kind of a turnkey solution. And then you also have two other ways to look at this. Number one, you can remove yourself well far away and obviously invest in the stock of the single family REITs like Invitation Homes, American Homes for Rent, who are both employing this strategy, and you're taking kind of a larger macro bet on the single family rental industry trend. Or you can invest passively with other operators as a limited partner. And so those are groups similar like myself, maybe a little smaller, but they'll go out and they'll raise capital from investors that are, you know, $25,000, $50,000, $75,000 at a time on projects that they've already got entitlements on, or they've already done the improvements on, and they're looking for additional equity to maybe recapitalize the deal. And so, you know, that works with people's personal funds, that works with their self-directed IRA funds, and that's a good way to enter the space, especially if you really don't have any experience with home building. And let me give a nice clean warning to everyone out there that maybe owns one or two rental properties and has done a little bit of light renovation. Home building is an entirely different universe. It is infinitely more complicated. It contains a ton more risk. So to just step into something and build your first house from the ground up, you should be well versed in all the risks and rewards of that business. So that's certainly something that I would caution against, even though it is garnering a lot of media attention. It is not for the faint of heart, and it's a big leap from your traditional single-family investor to ground-up construction.
Yeah, what I'm hearing, Dennis, is you got to do your due diligence and find the right partners to work with. James knows I'm really big on building a financial team and making sure that you have good team members in the stables ready to go to help you as you're navigating your various investments. So great, I appreciate that. Other question, I'm going to take a step back, maybe just from like a macro perspective. From a supply standpoint, if I'm an investor and I'm looking to, regardless of what market I'm looking to invest in, are you able to comment in terms of the supply of rental properties in the U.S. and what investors should be looking at from that perspective?
Sure. Well, I mean, so what you're seeing is a couple things. Number one, of the existing housing stock, the roughly 120 million houses in this country, you're seeing landlords own a greater and greater percentage of that. So historically, that number has been somewhere around 8 to 10%. That number is now trickling up to 12, 13%. And it's also starting to make a greater composition of the new houses being constructed. If you went back 5 years ago, you would be pretty tough to see anywhere in the country where more than 3 or 4% of those houses were being built for investors, whereas now that number is jumping up to 5 to 10 to even 15% in some markets. So, there's no doubt that the institutional investors and even small investors are coming in and picking off some of this inventory. And that goes back to your earlier question as well. If someone wants to get kind of into build to rent, they don't want to take any construction risk, you can obviously go to your home builder of choice in your market run your numbers and buy that, assuming the CCRs and HOAs allow it, buy that property for investment purposes yourself, and you'll actually have your, the home builder warranty attached to it too, which is nice. But there are a lot of restrictions around that in a lot of parts of the country, so you have to be careful for that you're not going to buy a property for rental purposes in a community that doesn't allow rentals or has a very limited number of rentals. But going back to your whole point about supply, supply is increasing quickly. The demand, though, is the exciting part for most of these investors because we've been chronically undersupplied. We've got this huge surge of millennial housing, demand from millennials for sale and for rental housing that has kind of offset that increase in demand, or in supply, excuse me.
Okay, so awesome. And then James, I'll one last question, and then I'll hand it back over to you. When we talk about this new construction, is it typically a single family, one unit, or are we talking 2-unit or triplexes? What does that most commonly look like?
The most prevalent product type has been single family detached and townhomes, followed by what I would call horizontal apartments, basically, which are usually single story bungalow type houses that don't really usually have garages, or if they do have a garage, it's a 1-car garage. Those units are much smaller. They're kind of size like apartments. These horizontal apartments that are, let's call them 1,800 to 1,300 square feet. Whereas the most prevalent product type is single family detached that's 1,500 to 2,200 square feet, or townhomes that are 1,300 to 1,800 square feet. Most of the product is 3 and 4 bedrooms, and 4 and 5 bedrooms have actually been increasing in demand as COVID has kind of delayed itself and more people continue to work from home. They're using those extra bedrooms as at-home offices. But whether or not that trend stays around long term, who knows?
Awesome. So let me jump in. You brought up a couple of the REITs, and specifically, on the Building Equity podcast, we're not giving anybody any investment advice. That's our disclaimer. But I will go on record and say that I left the conference, look at the Build-to-Rent Craze. I'm like, this makes sense. How can I get in on it? You do your research and you say, well, wait a second. There's American Homes for Rent, Invitation Homes, Tricon Residential. Could you give, and if you could, Dennis, do you have an opinion on those 3 REITs? And maybe you can elaborate or not or whatnot. I can take this out too if you don't. I know I'm hitting you on the spot with this question, but just it's kind of an elementary way that our viewers, listeners could get into the build for rent. And just would love to know your opinions on those 3.
Sure. Well, all 3 are very well managed companies. Not that I'm biased, but I'm friends with several of the executives across all those firms, and they've done a great job of navigating the growth in this space. The one thing I would say from the build to rent perspective is, even as those 3 companies and others continue to expand within this new sector of SFR investing, it still makes a very small percentage of their overall portfolio. So when you're going to invest in a REIT and buy shares in that stock, you're really making more of a macro bet on the trend of single family rentals, rent growth, home price appreciation, and the macro bet that we are short on housing and long on demand.
Makes perfect sense. Let me hit you with this question. And this came up a handful of times when we were recording over the weekend. So you have Wall Street, you have some of these investors that have hundreds and hundreds of doors. I believe, Lafayette, I could be wrong, you guys have over 3,000 doors that you guys currently own, right?
That's right.
So what if if we get into an 07, 08 and people just stop paying their rent, what is the counter argument to that on why the build for rent is a good investment today?
Well, the counter argument is they didn't stop paying their rent in 07 and 08. They stopped paying their mortgages. So two completely different scenarios here, because people ultimately have to live somewhere. And I think if COVID showed you anything, even when there was a moratorium on evictions, people still paid their rent. So the nice part about owning housing it's a needed asset, right? It's not, offices aren't needed quite the same way. Retail centers aren't quite needed the same way as housing. So this is kind of the ground floor for stability. And if you actually look at what happened during the recession last time, yeah, home building and the for sale market got beat up. But for the multifamily market, it was a bump in the road, except for really the lowest of the low, or areas that had expanded a little too fast and retracted back in terms of the housing supply. So you saw vacancy go up in some multifamily markets, but you didn't really see it go up across the country, and you didn't see rents drop off of a cliff the way you saw home prices drop off of a cliff. And I think you would have to have a lot of, in this environment right now where we've been on this inflationary run where a lot of equity has been created, much like the namesake of your show, America is sitting on more cash right now than they know what to do with. And that's part of the problem. That's part of the cause of this inflation is there's too much capital around chasing deals, and it's pushing asset values up, not only across real estate, but across really every type of cohort you could think of.
So my last question for you is going to be more macro level, but I have two more. Basic principles show that, hey, if you want to be a landlord and you want to have a good number of properties, follow the population growth in your local area, follow the jobs. Without giving away your secret sauce, could you maybe coach some of our viewers, listeners on where they can go to, maybe locally or in their state, where they can get an idea of, hey, where's the population growth going to happen in my state, or where would I know that XYZ corporation is moving and that's going to bring 300 jobs to the area? Do you have any elementary X's and O's that you can
Sure.
coach them through?
Yeah, number one, I'll tell you, anyone that tells you that there's a secret sauce is usually full of it. It's just usually hard work and knowing how to find information. And what's awesome about understanding demographic and economic trends in our country is almost all that information is free. Now, granted, there's micro level data that you can pay for from a number of great data providers, but the best source of information in this country is the U.S. Census Bureau. And the Bureau of Economic Analysis. From that, you can understand what areas in the country are growing from an economic perspective, from a population perspective, what the average household and median household income is, and literally, I think it's censusbureau.gov or census.gov is the website, and they have great reports down to the county and city level. That will show you how population has changed over the last 40 or 50 years and how it's expected to change over the next 40 or 50 years. And you're right, job growth and household growth are the primary drivers of demand. But that doesn't mean you have to be in those markets to be successful. It's just that those markets are where you're probably going to have the greatest demand for your rental houses. But, I would tell people to understand their own market first before they understand other markets, go to other markets. I like to say that, investing doesn't have a border, but it's so much easier to digest and understand your market first and understand what drives your market before you start jumping into other ones. So understanding those demand characteristics, why do people like the market you're in? Or maybe people don't like the market you're in and you're losing population. If that case, what are nearby places that are attracting? And all of this changes over time as well. If you look at a lot of cities like in the Rust Belt, places like Cleveland and Buffalo, and a lot of these cities that lost population from really the late 1960s all the way until a few years ago. Well, these places are now seen as highly affordable, and they're reinventing themselves, and they're actually adding population back in. And so they're producing some of the best yields in the country right now. Big institutional investors are a little skittish of these markets, but that doesn't mean that there's not an opportunity for you. In fact, there's probably more opportunity for the average investor in some of these smaller markets that are growing because larger investors aren't going to go and jump in with both feet unless they know they can get scale in that market immediately. And it's hitting the highest numbers of growth, which some of these places aren't quite doing yet, but they're poised to do so.
John Bowens, I told you I was always going to point out when we bring substantive information to the table that our listeners, our viewers, however they're consuming this content, go back and rewind and just listen to what Dennis said. He's giving you a roadmap and showing that everybody can get in on this. And to get even a little bit more macro level, and if John, you want to jump in, please don't cut me off. But I mean, there's personal questions I want to ask Dennis. So from a macro level, they say 40% of every dollar that's in circulation worldwide was printed after COVID. Stock market at the highest levels. Obviously, this is changing in the last couple of days. Home values through the roof, rental prices up. Everything is the best it's ever possibly been. And now you're starting to see the inflation. Now you're going to start to see the interest rate adjustments. Now you're seeing a war literally in Europe. What do you believe? Do you believe that real estate investing is I'm going to say the end all be all insulator to kind of all of these external forces playing against our economy? Where do you see 10 years, maybe next 24 months, not 10 years, 12 months, 24 months in real estate investing?
Yeah, James. So I'll jump in here, and Dennis, feel free to follow up on my commentary. We're real estate investors. That's what we focus on. Obviously, disclaimer like you did before, James. We don't have a crystal ball. We don't know exactly what's going to happen in the stock market. We don't know what's going to happen in the overall global economy. We know inflation is real. I think that's a piece of factual evidence that we can state today. But I'll tell just a quick story. When the pandemic hit, and I had multiple family members reaching out to me, and it's interesting, people reach out to me. I'm not a financial advisor. I don't give advice, but people will reach out to me knowing the business that I'm in and what I do from an investment perspective in and outside of real estate. And most of the folks that I spoke to, they had taken anywhere between a 15 to 20% haircut in their stock market based portfolio. So if you look at the stock market at that time, we saw about a 20% downturn, and very quickly that recovered, right? We can all say, okay, once stimulus picked up, once this whole pandemic, everything was figured out, the stock market came roaring back, which was great for people because they didn't have to take huge losses like they did in the Great Recession back in 2008 and 2009. But during that time, my rental properties appreciated in value. So while most other individuals were suffering losses in their portfolio, our properties were appreciating in value. Our rents were still coming in. So our tenants were making payments on time. So I'm not going to say that we are fully insulated from an economic downturn because we're invested in real estate. But what I will say, and this is just personal, what I will say is we feel a lot more comfortable being in a real estate position than we do 100% invested in a stock market-based portfolio. And that philosophy that I carry with me is the same philosophy that most of the individuals that I work with on a daily basis carry. And so I don't know if that sheds any wisdom or kind of outlook or direction for anyone. But if you're somebody that's out there that's interested in real estate, you're curious, know that there's a lot of other investors out there that are trying to do the same things, have done the same things successfully, and you can get help. I always talk about the real estate investor clubs all across the country. Just do an internet search of real estate investor club, and you should be able to find a group in your area, in your hometown, that are mom and pop real estate investors. Now, don't get me wrong. It's important to think about, what are the private equity firms? What are the Invitation Homes doing? What are the Zillows doing? All of that macroeconomic information is really, really important. But at the grassroots level, getting down to, like Dennis said before, I love what he said, which is know your market. Learn your market, navigate your market before you move on to another market. And it can start with working with mom and pop investors in your local community and networking with like-minded individuals.
Dennis, what's your take?
Well, that was a wide-ranging answer, so there's lots of things to pick up from that. Number one, inflation isn't here; it's been here for 2 years. We've just ignored it. The Fed has ignored it. We dumped so much money into the economy so quickly, and we already had strong cash positions, and that it's been pretty robust across the board. My concern is that the response from the Fed is going to be overkill, and they're going to raise interest rates too fast, too quickly, and there could be some related pain with that, because a lot of the other fundamentals in place are great, right? You compare it to other times where things seem too good to be true, like the Great Recession. Well, the issue there was we were issuing crappy mortgages to anyone that wanted one. Well, we're not doing that anymore. In fact, the average credit score of a new borrower is at its all-time high. Most loans have a substantial amount of down payment on them, but still, we're seeing home prices in a territory they haven't been before. And people are stretching their incomes, and we are getting to a point where if interest rates increase substantially, it's going to reduce the average consumer's buying power, and that could lead to some incentives in certain housing markets that are maybe not quite as undersupplied as others. But it's hard to tell because demand is just so robust right now, because we've been underbuilding for so long. And even worse, not enough people are really selling their houses right now. So you're seeing even the existing inventory at extremely low levels. So it's tough to say because a lot of the cards have not been shown yet. So it's hard to know what kind of hand to make out of this. I am cautiously optimistic for a little bit of appreciation this year, but I think there will be a leveling off in pricing. And I'm hoping that's really what the solution is not a correction that involves any type of price declines, but more of a leveling off for a few years that allows the economy to collectively catch its breath and kind of get back on track with a normal 2 to 3% annual growth. But between COVID and policies of both Trump and Biden, both guys wanted to keep this economy afloat at all costs. And both of them pulled triggers they didn't necessarily have to pull to keep the economy afloat. And so we're paying for some of that now.
Excellent answer. Excellent answer. And here would be the last question I ask you, Dennis, and feel free to, John actually mentioned Zillow, and literally the panel I saw you on, this was, had to be late November. So it was just after the Zillow announcement, and you off the cuff made a Zillow reference, and then you looked around, the room was complete silence, and you're like, too soon? Too soon? And I thought it was hysterical. Now, today at 5 o'clock is Open Doors fourth quarter earnings calls. And I'm not sure if you had a chance to see where their stock is, a greater than 65% decrease in a 1-year period. What is your take right now, just overall on the iBuyer market, Zillow's exit? And, let me just set the table too on this real quick before you answer. I was at Inman when the announcement was made about Zillow, and the other iBuyer companies were up on stage, and they were extremely brash about that move that Zillow made. And sure seems like the writing is on the wall for all of them, in my opinion, but would love to know your take.
I'm not a huge fan of the iBuyer business model, and I think most sophisticated investors would echo my sentiments, even if they are not brave enough to say it aloud. What is it exactly that they're doing? They're buying a house, hopefully cheap enough, and they're doing this all based on computer algorithms. Let me tell you, if Zillow's algorithm is wrong, everybody else's algorithm is probably a little off too. The only difference is Zillow got very aggressive in some of the wrong markets and got caught on the wrong side of thousands of transactions. But ultimately, these businesses are not creating, true profit. They're just creating revenue. And that is part of the issue right now, fundamentally, with a lot of companies and their valuations. They're based off of ridiculous multiples of revenue as opposed to actual earnings. And so when you look at how little things have to go wrong for an iBuyer to lose money on a transaction or to have paper thin margins, it starts to catch up with the investment community saying, well, I'm not really sure if I want to see a company that creates, $50 billion a year in revenue, but yet can barely eke out a profit year over year. And this is at a time when home prices have been on absolute fire. I look at it as akin to DoorDash, right? DoorDash had the entire universe of restaurants closed and people having to use their service, and they still couldn't turn a profit. What are their prospects long term to be able to get into the black? I don't think it's very good. So, I'm not long on those strategies. I think they're easy to scale because they're doing everything digitally. But scaling something that doesn't make money means all you're doing is increasing your losses on a geometric scale. So I'm not a big believer in that long term. I don't think they're creating value. They overpay for their services, and then even worse, when they try to vertically align those services into their own companies, it's wildly inefficient. So I've seen this firsthand. I have a number of colleagues who used to be employees of Zillow, of Open Door, of OfferPad, and whether anyone wants to admit it or not, they're all kind of going to suffer the same fate eventually.
We are here on the Building Equity podcast for real estate investors, and I couldn't be happier to have Dennis Cisterna from Lafayette Communities, the Chief Investment Officer, a build-to-rent expert in the entire industry. John, I don't think today's episode could have been any better. Do you?
I agree. Yeah, awesome, Dennis. Thank you for coming on, sharing all these great insights with our viewers, and hopefully we can have you again on the show sometime soon.
Thank you. Really appreciate the opportunity.
Now, listen, before we go, we always have a final segment, and it is This Day in Real Estate Investing History. And it's brought to you by Equity Trust. Unleash your inner real estate mogul. Discover your potential as an investor by maximizing the power and possibilities of buying and selling real estate with your retirement account. U.S. News calls them the top 7 IRA accounts for 2022. Investopedia says best overall self-directed IRA company. With $34 billion in assets under custody, start the conversation today at trustetc.com. And now let me bring this over here. Dennis, I did this one for you, bud, because you are the build-to-rent expert. You should be able to see this. This is a Rock Hill, South Carolina, the Evening Herald newspaper from March 3rd, 1936. And right dab in the center, I'm going to zoom in so you guys can see it, because I know you guys, history repeats itself. That's why we're doing this here. 8 homes built in a month. If you guys can see that right there, the building inspector reports $25,150 for February. The monthly report, Mr. Flowers showed $700 in repair permits and $24,450 in new construction. 8 new homes were built, Dennis, in 1936 in South Carolina. And what I love about it is that's the wonderful build for rent craze. So once again, everybody, thank you for tuning into the Building Equity podcast. Thank you again, John Bowens. Thank you, Dennis Cisterna. Hope to have you back on. And we wish everybody has a great, great day, and we'll see you on the next one.